Good morning, everyone. Thanks again for inviting me to this session. My name is Ope Onibokun, managing partner at Highstream Investments, where we help clients mobilize capital and do a lot of advisory support within the infrastructure space. Prior to this, I worked at the British International Investment BI, where I led investments and origination for Africa and Southeast Asia in the ports and logistics sector.
Good morning. It's such a pleasure to be here. Thank you so much for having me. I look forward to a great conversation. My name is Rochelle Moré-Oshodi. I'm the managing director of ARM-Harith. We are a private equity fund based in Lagos, Nigeria, focusing on investing in critical infrastructure across the continent. So from energy access, efficient transportation and connectivity, we invest in projects that not only, of course, deliver returns for our investors, but also tremendous impact. And we do that by focusing on ESG, climate resiliency nowadays, and of course, involving communities for the development that we're trying to create. I think one unique aspect also that I want to mention about us is we do really focus on investing with local investors, which on the infra space we had not seen enough. And I think now we have local pension funds really coming into the infrastructure space. And so we do blend global capital with local capital, which also allow us to mitigate one of the key issues that investors have, which is the FX volatility that we've seen in the region. Thank you.
Thank you. I wear many hats, but today I'll be wearing. So I'm the head of actuarial for National Insurance Commission Ghana, formerly a director at Moody's Analytics as well. What I've been engaged in is we're trying to have more insurance penetration, even in the region of Ghana, and more inclusive insurance. The space is vast, and that's what I've been working on, basically trying to make sure that the Commission is in the right space to accept these risks, and also as a market be able to grow, and Ghana be one of the hubs for insurance when it comes to the West African region. Yeah, thank you.
Thank you, Kobena. Ope, I just mentioned the size of the infrastructure market in Africa. It's vast, and it's not being funded to the demand from the markets. From your experience, what are the key areas, issues in the investment thesis that investors are looking for before they commit capital? But also, more importantly, how do African investors get into this space? What are they looking for?
So maybe I would like to start off by almost painting a picture of some of the dire infrastructure needs. So I'll take, for example, in the transportation sector. So if you are a importer, let's say in my friend Babagana, who's based in Ouagadougou, that's somewhere in Burkina Faso, and that's a landlocked country, and you have to import a 20-foot container of rice, TU, from China, because you're importing rice to feed people in Burkina Faso because there's not enough agricultural production that to meet the needs. And I think there's going to be an agricultural panel to discuss this point. So you have to get the container from Shanghai. It's going to cost you about $3,000 landing cost for it to go from the port of Shanghai all the way through the Red Sea, the Indian Ocean, and you land at Port of Tema, which is one of the closest ports in Ghana, which is a neighboring country to Burkina Faso. Once the container arrives in Port of Tema, there is then a need to handle and offload the container. You end up spending perhaps 10 to 12 days due to port inefficiencies in getting that container off the vessel. And then you have to pay your terminal handling fees, plus a potential unknown fee to custom officials to expedite you being able to take your container out. And then from Port of Tema, the road network is about 1,000 kilometers to Ouagadougou. And of course, we know the roads in many African countries are not the best, lots of potholes. But besides the road itself, there's also the fact that every 50 kilometers, there'll be a police checkpoint to check to see what's in your cargo. You'll be stopped several times. And then when you're about to cross the border, there'll be issues of border crossing. By the time that container gets to Baba Gana's shop in Ouagadougou, it's probably spent around another $4,500. So it costs more to get the goods from Port of Tema to Ouagadougou than it costs to actually bring it all the way from Shanghai to Tema. And I think this paints the issues around the inefficiencies and the issues we have in infrastructure, because that costs, which is about almost $8,000, is going to be passed on to the consumer, who actually already constrained in terms of like disposable income. So if we are able to improve and invest in infrastructure, there's a potential at least 20% saving just in inefficiencies that could be gained that will be passed on to the users. So I think this again points to one of the issues. And I think the question is like, given the opportunity, why isn't everybody trying to invest in the African infrastructure space? And the issues, I guess, are numerous, but I think for me, one of the key things that stand out is also around issues around the ease of doing business. I think the governments haven't done a great job of making things a lot easier. So there are a few low-hanging fruits, like for example, making border crossings a bit more efficient. You don't need, a lot of capital to make that efficiencies happen. Making it easy to get your goods cleared in the ports. So I think some of the ease of doing business issues remain a constraint. Another point as well to highlight in terms of policies, also around consistency in policy. So when you set policies out, if governments are able to stick to those policies, it gives investors a clarity around, you're going to bring capital in the next 10 to 15 years, because infrastructure it requires long-term capital. But then I think the issues we also have is around the governance, because if you have elections every 4 years, or you're not sure who's going to come into power because there'll be a coup, and every government comes in with its own policies, there's inconsistencies. And it's not only in Africa, I would say that this happens. It happens here in the UK as well. So it's not an African problem. I think what infrastructure needs, or investments in infrastructure needs, is consistent policy. Investors want clarity around cash flows. So whatever you need to do to enhance that, de-risk their investment, and provide clarity would help us to solve the infrastructure bottleneck.
Ope, thank you for that. You raised an interesting word there, risk. And I think the challenge in Africa is perception of risk is very different from the reality of risk. So Rachel, where do you come from when you look at the risk profile, and what's recent examples on projects you've looked at that have really facilitated the mobilization of capital into the projects you've invested?
Thank you. I'm going to piggyback on where Ope stopped. It's interesting. I've been involved in the infrastructure sector for over 25 years now. And I moved from private sector, worked with DFIs, worked with commercial banks, and now running a fund. And what hasn't changed is exactly what you mentioned, is the lack of consistency in regulation, in policy, and really having both public and private sector working together in a manner that is consistent. And what is now clear is that we cannot continue to wait for all of that to happen, because we still have 600 million people in the dark. So when we're talking about terabytes of capacity from data center, when I'm in the US, I'm talking about providing a light bulb for students to be able to study, or for hospitals to be able to operate. We are not leaving people, the next generation, behind. We're leaving them literally with no chance of catching up if we don't act. And so what we've stopped doing is to wait for government, policymakers, et cetera, to come to the table. I think we've talked a lot. For 25 years, we've been saying the same things. So what we've decided to do is to take matter into our own hands and to really be able to demonstrate that in spite of the nuance and volatility that exists in the market, the inconsistencies, that's actually where the opportunity lie, believe it or not. And I think we all learned that in finance. Risk and opportunities go together, hand in hand, right? You just need to be able to price that risk properly and also to manage that risk properly. It is not an easy thing to do, but it's one where we are committed to continue to demonstrate that it can be done. And we do have, of course, example in the portfolio. I'm happy to talk about that. But I just want to point out to data as well. We have sovereigns on the continent that are paying 2.9 percentage points above what counterparts with similar, risk, or actually worse risk profile would pay, because we have a defaulting rate when it comes to infrastructure on the continent of 1.7% versus 10% in 13% in Latin America and 10% in Eastern Europe, right? So infrastructure asset class on the continent is the best performing across the globe. Yet we are still paying a premium. The debate of whether it is a perceived risk or actual risk, or do we have, is it a bias? I don't want to get into that. I think it's going to be a long debate. And I think there are works that are now being done for institutions to be able to rate properly, when it comes to sovereign or even private institutions. But the reality is that the only way to move away from the talk and to move into action is actually to demonstrate it. And that's what we're trying to do. So whether we have data that we can provide or not, we focusing on building structures and bringing innovative structures that are actually solving for the risks that investors are seeing. And those are real and tangible. And infrastructure, in my opinion, is actually the best way to demonstrate that. Why? Because the way we structure transactions are, first, we have clear line of sight when it comes to cash flows, when it comes to revenues. Those assets, should that be a road or a power plant, are typically monopolistic by nature. Right? It's not, you can't decide today, oh, I'm going to switch off from this grid and go and get power elsewhere, right? Or not go through that road. So typically you have clear revenues. So if you have structured your contract revenue properly, you actually have cash flows that are essentially inflation hedged, indexed for the most part, and that actually can generate revenue for the next 15, 20 years. Pretty much, in a stable manner. The second thing is you also have very robust construction contract, typically with liquidated damages for when the contractor is not performing. You have operation and maintenance. With all the bells and whistles on those contracts, you actually also pretty much insulating the project from construction risk and operating risk by having the parties providing those services bearing that risk. You have the insurance for property damage, etc. So you also quite insulating the asset itself from what could be wrong or could go wrong during that 15, 20-year tenor. And then lastly, for the risk, really, and I mentioned currency, for example, even though you do have indexation during in your revenue contract, there are certain risks that you can't, at least the amplitude of it, you can't necessarily sort of protect the asset. And the example is the devaluation we've seen in Ghana last year, even though now the currency is one of the best performing in the world. The devaluation we've seen in Nigeria. And when you have such drastic devaluation, it's really important really to have the local, capital, as I was mentioning, the currency, because for years, why were we structuring projects where you're getting your revenues in CDs or Naira, but your capital, your liabilities are in dollars or in euros? It didn't make any sense. And we did it for right reason. And I don't want to get into that too many details, but it was the right thing to do at the time. But now that we have been able to make progress with the regulator and for pension funds to be able to invest in infrastructure, there's no better match for their capital than to be paired with the stable long-term cash flows that infrastructure asset do provide. And I'm glad that we've been able to make those progress. So now we do have pension funds in the capital stack, really mitigating this FX volatility and risk that projects were bearing. And at the end of the day, we'll say they are not performing, when actually, when you look in local currency, they are performing, but we're unable to keep up with the pace of devaluation. So essentially, to give examples, we have in our portfolio where we've been able to attract pretty much capital from most of the global institutions and DFIs. We needed about 1.2 billion for an RPP project in Nigeria. And that project today is providing 10% of the capacity at the, on the grid. It was an expensive project. So, and that's where I want to go with saying we need to be consistent. It's the first privately financed IPP in the country post reforms and post privatization of the national utility, but it's one where you had an equation of about 2.53 million per megawatt, when really the benchmark is 1 million per megawatt. It's a 461 megawatt power plant. The price for that, especially when you do something new, investors do want to be credit enhanced for pretty much every risk. So a lot of that went into insurance. We had MIGA, for example, for repatriation of funds. There's all kinds of bells and whistles that were put in that project because it was the first one. And we shouldn't have stopped there. Unfortunately, we stopped there, but it's almost like when you invest in the capital market and the stock goes down. If you pull your investment at that time, you've crystallized that loss. If you stay the course, you would reap over time, right, the benefit of that investment. And that's the unfortunate nature of that particular one, where it was supposed to be the one demonstrating to investors that it can be done, and the ones following would have been cheaper, much cheaper. And you would see what happened in South Africa, where today you have actually less than, very little, I think it's 5 cents per kilowatt hour now, that actually 3, that you have in South Africa when it started quite high because of the demonstration effect and the fact that investors now have confidence and don't need that much risk pricing, if you'd like, and also there's efficiencies in how things are done. And so that's what I want to encourage government or policymakers, et cetera, is to really, for us to be consistent and not do a one-off where we need to replicate and do the same thing over and over in a space of every 5 years or 10 years. With 600 million people in the dark, we can't afford to continue building those generation assets at that pace. And there's really nothing preventing us from doing it. It is bankable. It's a model that works. There's no energy provider company in the world that won't make money. All the grids in the world are going to double capacity in the coming years, in the next decade. With data center, with the way we consume data, it's a no-brainer. I still don't understand why we're not able to do it faster, but this is really what we are trying to do. And for investors like us, we face the challenge where we can actually move fast, but we face the challenge of having investors, global investors, backing local fund manager like us, right? Because it's also the narrative. It is risky. It is, what we hear is fund managers on the continent are not performing. All kinds of different things that we hear, which necessarily are not always true, and we need to be able to navigate by demonstrating and showing data of our track record and returns. But there's definitely an investment case, very clear investment case to be made. Yes.
A lot there, Rachel. Ope, just before I go on to Kwabena, we talked about the perceptions of risk, and from your previous life in BII, what practical advice would you give to project sponsors or investors to break down those perceptions and understand the reality? Where would they go to understand the reality of risks?
Yeah. So Rachel did touch upon some of those risks. So while as an investor involved in capital deployment of billions of dollars across the infrastructure space, I think one of the lessons learned for me, or mistakes that potentially I see investors making, is that international investors, for example, will come into different markets, whether it's Nigeria or Ghana, and they want to own 100% equity stake in a project, almost leaving nothing on the table in terms of like for the locals. So what you end up having is that yes, you raise a lot of capital for projects in Africa, but ultimately all those capital flows out because through dividend payments, debt repayments, so there's really nothing left. And so you're pretty much repeating the cycle of what you have in the Nigerian oil sector, whereby in Nigeria, in the Niger Delta, you have all the oil majors investing and making money, but the local communities don't benefit from that. So what I encourage investors to do, which is also the smart thing to do, is to de-risk by partnering with local partners, whether it's insurance or pension firms, like where Rachel works, or with local entrepreneurs, to help de-risk the investments. Because for one, at least some of that capital will stay onshore to be reinvested. But two, if there's issues around a political risk event, a political change, and a new government comes in, because that project had capital both from foreign investors, but also from local investors, many of which are either depositors in banks, local people. If the government tries to renege on any contracts, they're not only impacting foreign investors, but also impacting local depositors or locals in those countries. So they're going to have to think twice about that. So from a de-risking perspective, I think that's one key thing that investors underestimate around the power of local partners when structuring projects. So that's one example. Number two will also be around what Rachel already talked about around what we call the Africa premium, the risk premium. And a lot of people kind of group Africa in one block and say, oh, it's risky. But then that's a lazy way of doing things. I think investors who have lived on the continent or who are aware, you need to figure out how do you separate Ghana from Nigeria, from different markets. Even within risky markets, I'll give you an example. In Somalia, which is a effectively country-affected country, there are regions in Somalia that are actually a lot safe and I can walk around easily. Places like Barbara, it's not just Mogadishu. So you have to, even within a country, separate the risk. And a recent project actually closed in Somalia, one done by BRI, my former employer, where they invested with DP World in a port called Port of Barbara, which is in Somaliland. And that port serves countries like Ethiopia and some of the landlocked countries. And that's a potentially profitable investment that was made in a conflict-affected country like Somalia. Also, in Somalia as well, you have an example of diaspora funding that was used to fund a port called Port of Garasad. So about $120 million was raised by locals and diaspora, almost like a diaspora bond time structure, to fund a port to help to be used, to help transport, improve logistics cost in the country. So even in a very high-risk country, you have to be able to differentiate and separate the risk. So that applies across the continent. So hence, when you're looking at how do you price this, I think it should be risk-adjusted or factoring in the local the dynamics. Another example is Nigeria is such a big country. Of course, we all hear about Boko Haram, but it's not good. But a lot of the activities there operates, a lot of the disruption is in the northern part of the country. Africa or Nigeria is such a big country. I think it's definitely, in terms of, it's almost like 900,000 square meters or so, which is a massive piece of area of land. And so if you operate in the southwest part of Nigeria or southeast part of Nigeria, the risk of the pricing should reflect that is a less risky region than what the Nigeria risk premium actually presents. So I think those are two things I think investors should bear in mind. And how can they potentially get supports? I'm sure we're going to talk about this later in the panel around de-risking instruments, the role of DFIs, MDBs to help provide credit enhancements to make it attractive to bring in foreign capital into African projects. So I'll pause there so you can ask the next question.
Kwabena, we've heard the phrase sticky capital, which is the domestic capital. let's take Ghana, for example. The capital markets there, $7.6 billion held by pension funds and insurance companies in Ghana. That's an awful lot of money that could close a big infrastructure gap. What have been the barriers to the capital markets to mobilizing in the infrastructure space from your perspective?
It's just one. Yeah. I think there's been certain policies set through by the government that's inhibited these monies to be deployed into such infrastructure. If I take a step back, for instance, 2022, there's this domestic debt exchange program, DDEP, where the government tried to sort of restructure the debt, had severe impact on these financial institutions. This was just, if you think about it, it's just give me your current bonds and then exchange it for another bond with different interest and maturity. This has actually caused quite a severe impact on insurance, them meeting their capital. So to mention, one of the key things is now they're struggling to meet the capital requirements as financial institutions. Some banks had to fold up because of this particular program. This was all just to secure bailout from IMF. And you would have thought we have enough to actually, regulate ourselves enough to produce rather than, kill off some of our institutions for a bailout from IMF. So that definitely has been one key thing over the recent past that has cautioned these local financial institutions from actually investing in infrastructure. The procurement of these from these institutions into building the infrastructure is costly as well. So you're seeing loads of companies actually just going towards the treasury bills route and keeping the money there just to take that interest rather than putting it into something physical. And talking about something physical, and I echo what Rachel and Ope was saying there. There's real cash flow to be made in investing in infrastructure. You need a bit of safeguarding around that, though, to make sure that it actually works. And it normally feels as though it is impossible. And when you come into the insurance and the banking sector, the demonstration of capital, you are really penalized for investing in infrastructure to demonstrate capital. So would you rather put the money there, or would you hold it and then get the full credit of it to demonstrate as capital? Now, then you'd see that's the local capacity being, if you want, exhausted. Then you're thinking, how are we making sure we're attractive enough to then attract foreign investment? Then this comes into our, I would say, from the policy making side of things, or the regulators like myself in the NIC, sort of being able to actually quantify our risk to make sure that we don't have companies struggling, create that particular stable market that an investor will see and say, okay, the Ghana insurance market is like this. I feel confident investing in that. Now we're a bit far off that. We're still working our way to that. Also giving that investor confidence that if I bring in that money from outside, I'll be able to sort of repatriate my money, because once it comes in there, also there are policies. So I think government and as regulators should be able to look around these particular, I would say, policies of not being able to take your money easily out of the economy once it comes in. So it's like an open door to come in, but also able to take it out. So I would say, for me, the demonstration of capital, the residual effect of the DDEP currently, and maybe a little bit of an instability on the market. These are contributing to us not seeing money being deployed into the infrastructure space. Yeah.
So Rachel, you're nodding your head there. I suspect you acknowledge a lot of those challenges there. But one of the areas that's often not talked about in the infrastructure space with domestic capital is the secondary markets. Perhaps that's a space where they'd be more willing to invest rather than in the primary market. What is your experience there, and what are the barriers for creating that secondary market? Nigeria's got some of the deepest capital markets on the continent.
So what's interesting with what you were saying is that if I've heard you right, the bulk of the reasons why pension funds and insurance companies are not investing in infrastructure is because of lack of results or outcome from governments behavior, right? So which is which is always sort of very interesting to see. And what we've tried to do is really to insulate those institutions from those market risks, which is really what we, when you structure a transaction, you have to be able to look at the environment and be able to mitigate all the risks from a macro standpoint, from an industry standpoint, and from a project standpoint that might affect your investment. Pension funds, actually, to give and to say that we are getting there, it's small, but on the secondary market, once we structure, because we come in early into projects, right? So we come in, we're providing the early capital, which is the riskiest, to be able to take a concept, an idea, into what we call bankability. Bankability is the point where other financiers, mainly debt providers, would say, okay, I think the project is structured and de-risked enough for my capital to come in. What we don't see enough is that early capital, coming to be able to come in to do that. There's a lot of technical assistance that we see from DFIs, but technical assistance is not that equity layer that really need to be there for the project to attract the debt to reach financial close. So we were very keen on convincing pension funds to come in. Coming into debt is a different thing, as I mentioned. Coming into equity and having a project that would take 3 to 5 years to develop and another 2 to 3 to build. So they had anywhere from 3 to 8 years of illiquidity, meaning there was no cash flow, right? And so even though they liked infrastructure because of what I mentioned earlier, they didn't like that phase. And so we had to partner with DFIs to be able to structure a layer of capital that will be able to give them liquidity. I'm not going to talk about it, but what we've seen is that for the ones who trusted us at the beginning, they then started to talk among themselves. And because of results, and that's the only thing really we can provide. We have to deliver, outcome. We have to stop talking theory and concretely deliver returns. Because we've been able to do that, they've learned alongside us during the way, and they were the ones actually advocating for other pension funds to come in because of the track record. And now, when we're raising our second fund, we have 3 times the level of pension funds capital that we had in the first, and our exit are actually to pension funds. We are exiting an asset, an IPP asset in Ghana today. The buyer is a consortium of 7 pension funds. Why? Because they now understand that they're going to have stable cash flows of protected revenue. Those are protected, and that's what I say. There's a difference between the general PE and infrastructure PE. The cash flows of those assets if you have done the right thing, they are there. They're not going to disappear. And again, the inflection of inflation protected and the indexed. If you have structured your contract right, you are guaranteed, contractually at least, to get these cash flows, recurring cash flows for the next 10, 15 years. What is there not to like for pension funds and insurance companies? So we just need to be able to continue to demonstrate. I think the pickup, unfortunately for me, the pace is a bit slow. And all we asking from government and from regulators is really to look at the data. I know we are few and far between, and those data might not, for many, reflect the reality, but it reflects for sure the possibility. And all we're asking is to really focus on what's working and stop focusing on what's not working. And more importantly, that we stop wanting to change what's working. And it's working because of what you mentioned, because we're working with local promoters, we're working with the local realities, we've embedded it in how we do things. It's not a copy and paste model, it's very unique and bespoke, but it's working. And it needs to be replicated at a faster pace. And we're really inviting all the stakeholders. And what we've been able to structure is coming from a collection of DFIs, local pension funds, local promoters, regulators, working together to really find what's working and what can unlock that capital. It's 2 trillion that we have locked in on the continent right now, going to fixed income, not building the infrastructure that we need and the wealth that I guess the pensioners would love to have.
Can I add to?
Yeah, please do. Yeah.
I'd like to add to Rachel's point of secondaries. I think a few things that needs to be done is around how do we have a demonstration effect to prove to investors that these opportunities do exist. And Rachel brought up a point around if the focus, I guess, in recent times has been around building greenfield projects, but international pension funds are not that patient to wait to take on that construction risk and they want to see their cash flows materializing right away. I think one thing that could be done, in my view, immediately is, so there's that piece around cash flows. There's also a second piece around scale. Many projects that are developed in some of these African countries, they are perhaps subpar below $50 million, very small projects, even though the skill is required. So how do you create scalable projects? Because some investors, for example, ADIA, which is like the UAE Sovereign Wealth Fund, their minimum ticket size for a project might be $500 million or $1 billion. In Africa today, there are not that many projects that actually are $500 million, except in the oil and gas sector or in the extractive. So for you to attract ADIA or even US pension funds who want to invest multi-billion dollars in projects, you can be presenting $50 million projects, $20 million projects, because they won't take you seriously. So how do we get that skill? So I think one of the solutions that could be done is around capital recycling or investment asset recycling. Today, many African countries have airports that are operating. They have several assets that are actually owned by states. There should be a massive privatization effort. Privatize those airports because they're cash generated, and create large pools of like an airport holding company. Let's say a country like Nigeria or Senegal, privatize all its operating assets and brings in the private sector to operate that. On day one, you can demonstrate cash flows to investors, and subsequently you can then start building new projects. Or it's in the road project. There are also some roads that are actually been built properly, whereas bridges, privatize those roads, or airports. So I think if we can replicate what was done in the telecom sector, in other sectors, you're going to see a massive investments in those sectors, showing track record, which helps to solve the issue of skill and cash flows. So that's something I'd like to add around secondaries.
Kwabena, in terms of the secondary market, what would you like the developer sector to come to you as a regulator and push you on in terms of policy change?
That's a very interesting question. I think for them to have success in pushing the policy, data is a big part. I speak as an actuary, and a lot of financial analysts will be looking forward to that performance indicator. So capital rules can be flexed, for instance, for the insurance company to make it attractive for them to go into that particular infrastructure, domestic infrastructure space. And with that, it makes it easier for the insurance company because it's more, right, the regulator is looking at it kindly. But before that happens, we need to see that result. We need to see that performance. There's an insurance company that's now in a little bit of an issue because everything is tied up in infrastructure. And then the call for capital when adverse events happen as an insurer, for instance, or as a bank, when people are coming for their money as a swam, now becomes difficult. So we should demonstrate that these secondary markets are liquid enough to be able to produce when required. Now, if you look at some of the projects, they're quite long-term, as Rachel alluded to, and illiquid. The question is, have they got instruments along that line that can help them shore up any sort of margin call or capital call? This is the test that as an actuary, as all other financial analysts, we are looking at to say, right, is this something that the insurance should hold or the bank should hold as a legitimate capital? And so if that's the case, the bank would be more with that freedom to deploy capital into these spaces. So unfortunately, that hasn't been the case. And whenever also, the other thing is when you get into this market, it's quite vague sometimes. You have certain gray areas where you would say unregulated space. And so it is difficult to know whether the money that's being declared is actually that money or it's something else. So I think we need to do more with data and be able to, data that is audited and be able to, demonstrate that. In demonstrating that, I think we get somewhere with the changing in some of these policies that really should help.
And on that liquidity point, should the stock exchanges be creating new asset classes and the regulations for infrastructure investment trusts, for example?
So that was one of my points that I wrote down, that our investment market is quite limited in scope. And again, even the stocks on the stock exchange are not as tradable. You'd struggle to get someone to buy stocks off you if you're holding, if you're holding a Stanbic shares and these are quite big banks and quite stable ones, but then you're still, struggling to get people to buy the shares off you. And why is this? Again, it's the confidence that maybe what we're seeing on the balance sheets are not really what the person is experiencing. If my net asset value on the balance sheet is X and the stock price isn't reflective of that, or there's no premium on it, then as an investor coming in, it's quite difficult for me to actually take on that. And by the way, I don't know what is down the road for that particular bank. Why are they floating some of these shares? Is it that they're going to get into trouble later on with one regulation or the other? So this is quite difficult to actually trade your instruments around. Apart from that, which is the current instrument, apart from that, the market is slim. We don't have derivatives on the market. We don't have some of these credit default swaps. We can't hedge interest rate well within our domestic market. So it's quite difficult for someone maybe looking at your statement with a IFRS statement and say, right, this is a good investment and I want to invest in that, or I want to buy the shares of that person. Yeah.
Thanks, Ruben. Just very conscious of time, the last question for the whole panel. There's been much said about blended finance. I'm hearing perhaps an ask there for first loss type guarantees in place. Where do you see blended impact capital and its role in delivery of infrastructure on the continents?
I need to go to Ghana because I need to I need to convince. I'm going to respond to that, but please allow me to just say that what you were just mentioning, it's exactly the kind of challenge that we like to tackle. And it's all about trust. And I know that trust has to be earned. And again, it has to be earned through delivery of tangible, outcome that can then lead to data, right? And so very excited about actually the potential that the continent still holds, because we're just scratching the surface right now. Blended finance is actually one of the key reasons why we've been able to attract local pension funds. We have, the way we are structured, I did mention the multi-currency vehicle that we have, but we also have a like a blended capital structure. We do benefit from junior capital from DFIs. AFDB is one. FSDA in the UK here is another one. And actually, what they provide, beyond just the first loss capital, which, just to explain, generally, first loss would allow, if a project is not generating the cash flows that were expected, the loss is going to be absorbed by that capital first before it hits the other investors. So it's actually protecting sort of the commercial investors. But in addition to providing us with that capital, because of the illiquid nature of the asset until they generate cash flows, FSDAI went beyond that and said, not only am I going to give you that capital in local currency, which is critical, but I'm going to allow for that capital to be used to provide early yield to pension funds during the time when you are developing and building those assets. That's how we've been able to attract local pension funds in equity infra, so coming in early and still be able to have that J-curve, instead of being like this, to be flattened, and for them to have recurring, or at least expect to have recurring cash flows, for the next 15, 20 years. So even though that yield early is not the full yield, but they're still getting liquidity that enables them to manage their own constituents if they want to take money out or reinvest. And when the project is now cash flow generating, then they're getting the sort of the capital appreciation that we create in creating value at the portfolio level. We wouldn't be able to do what we do without the blended finance. You really need that early capital that can absorb risk early, because it is going to be risky until you get to bankability fully. And without that capital, we cannot build a pipeline of projects that would then be financed by the debt providers, the commercial banks, the DFIs, et cetera, to now expand them and get to the scale that you were talking about. We need that, to bridge that gap, and we wouldn't be able to do what we do without it.
Yeah. To add to what Rachel has just talked about, she said something that we wouldn't be able to do what we do without that blended first loss capital. And this is a local pension fund. So think about a foreign investor or a foreign pension fund in the US or the UK. What will give them confidence to take on investments and take on Africa risk? And I'd like to just quickly step back and point to what the big issue is. There's over $4 trillion of private institutional capital out there. And of that $4 trillion annually invested, Africa only gets about 0.25% net, so almost nothing compared to what's out there. So the funds are out there looking for investments to make. There's a massive infrastructure need in Africa of over 130 to 150 billion dollars annually, or $170 billion annually by AFDB. There's money to be made, but yet this $4 trillion of capital is not flowing. And we have to ask ourselves the question, why? And the why really is around is the risk rating. So many of these international pension funds or insurance firms, fiduciary and due to regulatory constraints, they are unable to invest in instruments that are sub-investment grade or are considered risky. In Africa, only 2 countries in sub-Saharan in Africa, or let's say 3 countries, are actually investment grade. It's Botswana, Mauritius, and Morocco. Every other country is junk rated, CCC, B minus. So it's impossible to then ask foreign capital. Even if they wanted to, they cannot do it. So the way to then enhance that risk is the use of potentially blended capital, first loss, where you synthetically enhance the structure and make it attractive, at least allow the pension funds to come in. So I think that's just the point I want to raise around the role of blended finance capital. And there's the role of DFIs like BRI, Propaco, the IFC, who can play a key role in helping to provide this capital. Historically, they haven't really done a great job of doing this, but now I think the tide is changing, and they realize that for you to mobilize foreign capital, you need to create de-risking instruments. Otherwise, we're going to talk here all day, and 1 cent will stop, funds will not flow. So we have to attack the key issue around risk.
Yeah, so my colleagues are, I'm almost a defensive. I play the defense, and then they're playing the attacking, which is great. It's a great team. Yes, we do need that. We do need instruments that will allow us to de-risk our cash flows. And the challenge is these instruments aren't vanilla. Yeah, and I'll say the expertise to actually put hedging instruments in place is a challenge, even for us. So you would see the risk. You would want to basically model and make sure you're trying to de-risk the cash flow, just so to bring the results out. And I think that's also a challenge, and that challenge sips into the demonstration of the workability of it. So if you have loads of scenarios, the question is, where does this actual cash flow? So it's almost like let's wait and see game. And so we have the potential, and we do need that blended. We do need that blended capital style. But from my standpoint, it's more us being able to demonstrate, and it could take some time. So maybe the focus of building a formidable system that churns out the numbers over time, I think, and we being consistent with it, because another thing is we chop and change consistently most of these things. And if we stay consistent with it 5, 10, 15 years, we should be seeing a lot of these 4 trillion beginning to flow through into our space. That's what I'd say.
Thank you, Kubena. Ladies and gentlemen, you've heard a lot about risks, but the opportunities of infrastructure in Africa.